Hi, I'm here with Dennis Lopez, Chairman and CEO of QuadReal, a Canadian pension fund investor. Good to have you, Dennis. Welcome on board.
Well, thank you, guys. It's great to be here.
For those in the audience who don't know who you are, which I don't think there would be too many, why don't you give us a quick update on what does QuadReal do and scope and scale of the company?
Sure. QuadReal is owned by the province of British Columbia's pension fund, BCI. It was approved to be formed in 2016. We then started collecting our assets back from our asset managers in 17, completed that effort in May of 18. At that time, we had about 24 billion of assets, and the mandate was to grow an international business and build a big operating company. So today, or as of year end or first quarter, the assets are now up to 42 billion. So what's happened in that time period? We went on a massive hiring spree, hired about 600 people off the street, took 600 people in from the asset managers who were working on the projects before. We built a big operating company in Canada. We've got 172 people in development, a $12 billion development pipeline. And, you know, we're taking on primarily multifamily projects, but we've got a few big ones too. For example, we've got a mall here in Vancouver that we're putting $5.7 billion into and creating effectively the second city center of Vancouver. The last thing we did is in Canada, we wanted to keep the assets, which we got them around 20 billion, at 20 billion. So we've created a vehicle with RBC where once the properties become core, we can flip them into that entity. Outside of Canada, we opened up offices in Hong Kong, London, New York. We do programmatic investing with partners in sectors that we like, and we've increased the portfolio from initial 4 billion to 16 billion.
Wow.
Lastly, we took on the mortgage business last year. It's about 6 billion it lends in Canada and the US.
What has COVID-19 done to your investment program and to your growth?
Well, like everybody, we've learned how to work from home, and that's been worked out, you know, amazingly well. I've been really very proud to be part of the team that it's been pretty much seamless. But we nevertheless have had to get used to that. Really, it's had the biggest impact on probably the obvious thing, which is collecting rents. So generally, our retail portfolio is kind of did 35% in April collections. It's up to 40 here in May. And then office has been surprisingly good. I think it's because primarily we have CBD offices kind of in the high 90s. Multifamily's been kind of in the low 90s, and then industrial, because we have properties that have some small business in them, it's been probably in the high 80s. Yeah. So that's been the biggest impact.
So obviously income is impacted, occupancy, I'm sure, along with that may or may not start moving around. But with respect to your offensive strategies, growth, investment, et cetera, what have you been able to do and where?
Our view on the first opportunity was really in the public markets. So we've actually acquired an interest in a global securities fund manager or securities manager, and we've been in the process of allocating about $500 million into the public markets on a global basis. So we think that's probably the first opportunity. The second opportunity we've been seeing are more in structured finance deals, you know, taking mezzanine pieces, kind of different pieces of collateral, things like that, looking at tranches of debt securities that have really been trading at big discounts. So that's kind of what we're looking at now. And then we are starting conversations with platforms that may have issues right now. They're getting deferrals on rent or deferrals on interest payments. So things haven't really bit yet. But we're starting those discussions, but it's still early days for that. You know, some of the proposals that have come in are really looking for pre-COVID pricing to bail them out of post-COVID problems, and that doesn't really work.
So we'll talk.
It'll be a while for that.
Well, we'll talk in a bit about what do you expect values to settle at. But let's go back to these ideas, investment programs that you have been able to do, getting involved with the public markets, getting involved with the structured finance. Were those businesses and sectors that you were active before COVID, or was it just a quick reaction to an opportunity in a window that ended up being quite short, actually, and being able to move quickly?
Yeah, for the public markets, it's something that we've always had in the back of our mind. The firm I came from previously, AXA, as their CIO, I used to oversee, in addition to the private equity and private debt portfolio, about a $6 billion global REIT asset portfolio and a global listed REIT bond portfolio. So we had the same idea in starting up QuadReal. In fact, in saying QuadReal, we were thinking the four quadrants of real estate. That's why we named it QuadReal. So really, this is fulfilling something that we wanted to do, but then I must say it was opportunistic. So there had been a group that we've been talking to for probably about 9 months before the crisis. And, we thought it was interesting, but then when the crisis came and we saw, what's happened in the stock market with real estate stocks, we thought, wow, this is it. So we we moved within about 3 weeks to get to a point where we could deploy the first first 500 million in the market, and then also to finalize discussions pretty much on a term sheet, which we've now finalized for acquisition of a shareholder interest in the company.
So is your plan now to hold on to those shares at this basis, or was that a trading strategy? Get in, make money, get out?
The investment into the operating company is a long-term investment. We hope to grow that company and help them grow their AUM. The investment in the portfolios, we'll see. Yeah, I think longer term we'll continue. Now that we have the vehicle, we'll continue to operate in the public sector. The things that we can do there that we just don't want to do privately. So, for example, we're not really big fans of the emerging markets. We don't want to invest in the emerging markets because it's easy to get in and hard to get out. But, we can buy public securities and we can do that. So if we see, for example, I don't know, India or something like that is got great opportunities, we would do it in the public sector, not the private. The other thing too is property types. We're not big fans of hotel, but, at some point, in the public sector, the pricing's gotten pretty bad. The markets will get overdone. So I think going forward, right now we're taking advantage of what we think the opportunity the market's given us. Going forward, we use it for short-term plays on parts of the market we don't want to do privately.
Since the first $500 million investment that you made, have you continued to put money in the market, or are you at the moment on hold?
Well, right now we're kind of stepping it in. We don't quite get the broader stock, or the S&P 500, as we know, is right now trading at maybe 11% discount. The REIT index is closer to 30. So the overall euphoria in the market right now isn't quite what we think or we would have expected. So we're stepping in. So we're going to continue to step in, Gotti, and we're not going to put any big chunk in at a time. So we're kind of stepping in. We have been stepping in, and we'll continue to step in.
So you see the public markets being a significant portion of your overall investment strategy in real estate. So this is your foray into it.
Yeah, well, right now, it's for what we're doing right now on the margin. I mean, if we put $1 billion into it, that's $1 billion out of a $36 billion portfolio. So
nearly 3%.
Right. So it's another thing, another way to make money. Like I said, in the four quadrants, we really like the idea of being able to play whatever portion of the market we feel provides opportunities that are out of proportion to the risk.
I'm curious about what do you read, who do you talk to, what do you watch to form the opinions and come up with the strategies that you're coming up with?
Well, we have a great research group. We have 7 great researchers, and they're constantly chasing around on little projects I send them on, and my kind of half thought out ideas, and then they actually come back with the facts. So they're very helpful. But I mean, in terms of more public media, Bloomberg all the time, Wall Street Journal, the normal ones. The Economist, I've read cover to cover since I was, my mid-20s. Axios, which is something that probably not as many people know, is become a favorite. I look at that all the time.
Yeah.
And then too, frankly, I just Google stuff. I mean, I'm interested in something, I Google it, and then it kind of winds you down that little rabbit hole that, an hour later you realize that, that you've just been looking at different articles on the topic you're trying to understand.
Right. So looking back over the last 60 days, since the beginning of the pandemic, what have you missed? What opportunities or what situations did you just misjudge or didn't quite anticipate that you said, if I had it to do over again, I might do something different?
Well, and this goes to culture. So I'm an American, but I work at a firm full of Canadians. It's a Canadian firm. So they had experienced SARS and it didn't go well. Whereas I, as an American, I didn't even, I knew about it, but I read about it in the paper. So I would say early on, they were like, okay, we got to get ready. We got to do this. We got to tell people to start working at home. And I'm kind of like going, well, people have individual rights. You can't be telling that to people. Anyway, 2 weeks later, I figured out they were right. I was wrong. So I would say I was not as quick as they were to recognize the impact and breadth of this. The good news is that they were right. They did it anyway. They went ahead and moved everything ahead. So what I was slow to pick up, they picked up ahead of me.
Yeah. So world events like this are rare, but not completely absent from history. And perhaps you can't say 9/11 is the same as this, and you can't say GFC is the same as this, but there are some elements of every time we have a major crisis in America, at least, and I suppose around the world, conversations are things will never be the same again. And history tells us that actually, if you look 2, 3, 4 years later, look back on what happened and whether the new normal is vastly different than the old normal, it's closer to the old normal than not. Do you think that looking 5 years out, 3 years out, the new normal will be more or less what it was like back in January and February of this year? Or do you really think this time it's different and the world will be very different?
Yeah, well, I love sayings, and one of my favorite ones is Mark Twain, is that history doesn't repeat itself, but it rhymes.
Right.
And that's kind of what I think too. We're very much, in fact, we just literally had a session with our management board yesterday saying, okay, let's not overreact to what's going to happen until we have a vaccine. So from now until when they have a vaccine and it gets general distribution, we're muddling through, okay? But it's not long-term strategy. What we're really thinking about is the question you've asked is, what do things look like after we get the vaccine, it's distributed, and people kind of go back to normal life? Taking them by sectors, I think retail has changed, right? The department stores are gone. Omni-channel is critical. The positive thing on that, and I was talking to our head of retail yesterday, is he's saying that the amount of space that online retailers are going to be looking for could be 300 or 400 times, 300 or 400%, I should say, what they might be. And I think everybody's coming to the realization that, while we need less physical retail, it's not going away. And what you really need is to work between online and physical retail. But absolutely, we just don't need as much as we've got here in North America, the UK, probably Australia too. Office, the use is going to change. Everybody, I think, is maybe over extrapolating work from home. Yeah, it's worked for most people much better than anticipated. But I think what it's highlighted to me and to us is that if you really want to get a lot of stuff done, stay home. Look at your PC for 8 to 10 hours. Nobody will interrupt you. Nobody will bug you unless you have young kids or a dog. And you probably get a lot more done than if you go in the office and people are constantly stopping by and asking you questions. The reason you go to the office is, yeah, you want to get some work done, but you really want to collaborate with your colleagues. You have different views. You want to try and discuss it, reach conclusions. You want to try and learn. You want the random occurrences that you just wouldn't bump into the person. And that's really why you go to the office. You also, in firms that believe in culture, and we're a firm that believes in a strong culture, you need to build trust. You need to build relationships. And that doesn't happen in videos. I mean, it helps, but the reason things have worked so well for most companies, worked so well for us, is that we had a really established network of trust amongst everybody. So it worked. We've hired a few people in this crisis, and they don't know anybody, and they've struggled a bit. Yeah. So what does that mean for us? It means absolutely demand for office will be down, use of office will be different, and maybe we'll start thinking about why we go to the office, which is as much social as it is work.
Right. I happen to agree, and we're contemplating how we're going to come back to work. Right now, everybody's working from home, and we're toying with the idea of, you remember in college, the office hours for the professor? We're thinking about doing office days so that most, if not all, the people are there, let's say Monday, right? It's your staff meetings, it's your team meetings day, and then for the rest of the week, or a portion of the rest of the week, maybe it's more flexible. We haven't decided, but we'll see. The question, though, as a real estate investor, Dennis, is, as an operator, as a company, we have to make these decisions, but you're an investor. You own a lot of real estate, a lot of office. You will own even more probably in the future. And, for the last 15 years, owning a mall meant that you get the pleasure of investing $500 million to $1 billion to try to keep up with the changing trends, only to realize that as soon as you are completed with the project, you got to start all over again. And now maybe it's going away altogether, at least the department store aspect of it. So is an office, are the economics of owning and operating office real estate, given your outlook or given the uncertainty about that outlook, substantially changing your point of view about wanting to own real estate, and at what price?
Yeah, I mean, I think it's really making us question buying older property. I think probably the market's underestimating the CapEx required to bring it up to the standards required. So we'll be slow probably to go into older office. I think for well-placed new office, we would be, we're probably more open with the right locations and cities and tenants. So I think we'll be careful in office. We have historically been careful in office. And I mean, it's interesting. I think the pricing in retail has almost gotten so bad now that you can probably make the numbers work on those things. And we've also been a big believer in densification of retail. Pretty much, we've only got 5 malls here in Canada, and each one of them is in some step phase of densification, primarily around residential. So we've been doing that for a while, and we think there'll be more opportunities. And we think, especially on the B malls now, the prices are probably getting in the right zone. Office, the prices may take a little bit longer to get in the zone that's required to do on the older property what's necessary for the standards going forward people will want.
Yeah, I do have a little worry about where will the supply-demand settle down in the office sector with respect to the effective rates when it's all said and done. When you take all these conflicting factors into account, what can a company really pay for the space it leases, and how much space do they really want? And then what does it cost to run that business? But because of some new costs. So I just see at the moment, a lot of dark clouds on the horizon and a lot of uncertainty on that. So let's talk about apartments. You're a big believer in multifamily rentals. What's your view of that market? How does that settle? What changes in 2-3 years in the multifamily rental landscape?
Well, we are big believers. It's one of our key theses and globally as well. So we're big owners up here in Canada, and we're big owners in the U.S., and we've put a lot of money into both the PRS projects in the U.K., and we just started up a big joint venture with Hines to build multifamily in the continent. What I would say is we're probably most concerned about in the U.S. Up here, and we're most concerned with government regulation. Unlike most of the time where you're concerned with supply and demand, demand we think it'd be steady. There's been a huge affordability issue that's just now gotten worse. COVID's made it worse. So the thesis that we had behind multifamily of affordability, hasn't changed. In fact, it's gotten better. But the problem now is that the governments are stepping in and putting in regulation and rent control. So here in Canada, we've had to live with it for a while. We've gotten used to it. The governments have structured it in such a way that it still makes economic sense. It does have a hard time competing with condo, but it has a niche. In the States, we'll just have to see how it plays out. I think probably just a very initial reaction is that it's going to bias our investment towards states where we feel regulation in the future is less likely. But it's complex. Like many of these things, this is a trend that's been in place for a while. We've been studying it for quite a while. It's just going to be exacerbated by COVID-19. In Europe, once again, rent control has been in place for a while. I mean, what happens with rent control is that nothing's built and it gets worse and worse and worse. So actually in places like, let's say, Amsterdam, that's had it in place for 10 years, they've kind of done the opposite now. They realize that they have to loosen things up, and that's presenting opportunities. So, everybody knows the story on rent control. It's an easy thing to do initially. And over time, the properties degenerate. Over time, nothing's built. Over time, people realize they have to loosen up the regulations and people start building again. Unfortunately, I think in many states in the US, we're at the beginning of that cycle.
Yeah, it does come and go in cycles though, and 10 or 15-year cycles, it seems like where there's some very onerous regulation that goes into effect to control rents. 10 years later, there's a housing shortage in those markets. For 5 years, they try to figure a way out of it. Then they decide to do some lifting, usually by exempting new assets from rent control for at least a period of time. Those assets 15, 20 years later become subject to the then new wave of regulations. So it's a timing game. But I think you're probably right that in America, particularly in major markets like LA, New York, San Francisco, we're probably at the beginning of the 10 bad years, not the end of them, if you will. Bad only in terms of development, probably good for the people who live in those towns and need the relief from housing cost growth. So
right.
The market can solve a lot, maybe everything, but it's not going to be allowed to do it all on its own, right?
That's right. That's right.
So we spoke about retail, multifamily. We spoke about office. I'm curious about what's your take on industrial.
Okay, well, I mean, obviously that's an easy one. It's the winner, right? That along with data centers. So look, we had our conviction on multifamily is squared on industrial. So we have big industrial portfolios here in Canada, US, Mexico, UK, continent, in China, India. So we like that play and we like it more now. We'll keep going. What's going to be different? I think the rental rates now are maybe going to support more multi-story industrial, which isn't uncommon outside the United States and parts of the world, but is rather uncommon in the US. So we'll probably be seeing more of that. But there'll be some, maybe you have to rethink a little bit with the change in global supply, lines, but not too much. So it's been a sector that we've just loved for a long time. We just love it more.
So I agree with that, and I've loved it for a long time as well. Logistics, modern logistics particularly, is one area probably outperforming almost anything else in that overall category. On the other end of the spectrum, you have multi-tenant, local serving industrial space where it's quasi-retail, quasi-office, quasi-industrial, quasi-warehousing, but small multi-tenant type of things. And those that don't perform the same way, they don't even respond to the same market trends necessarily. In the industrial logistics space particularly, over the last 5 years, sort of the unsung story is that the development economics have gotten squeezed a lot. The big tenant have gotten much smarter about real estate, and they have decided that they've been creating way too much value for people like you and I, and that they're going to squeeze us on the rent. So it is a great space when you think about occupancies and rent growth, but it is more challenging from a development economics point of view. So do you have any concern about the viability of the feasibility of developing all this 10 billion square feet of industrial logistics space that is now being expected to be needed for the next 5 years?
Yeah, look, you're getting squeezed, but I guess it also depends on your view of your cost of capital, right? So I think we're definitely of the view that it's lower for longer. And I think, as I mentioned to you back when we were at the PREA conference, maybe forever, you know. So,
Right.
so we just don't see the cost of debt going up for a long time. I mean, we went out and got ourselves rated. We got rated AA low. We'll be issuing some bonds next week, way under 2%, fixed medium term. We put together a commercial paper program. We're borrowing. We rolled over about 150 million yesterday at 38 basis points.
That's amazing.
So yes, we are all going to get squeezed on logistics on the revenue side, and frankly, we're also playing very hard on the liability side to reduce our cost of capital, because really what matters is the spread, right?
Right. So we have another aspect which relates to not just logistics, but definitely is prevalent there, the duration. These are big, expensive buildings to build. The tenants come in, put a lot more improvements in them. So the prevailing thinking is that it's a 15-year lease and this tenant isn't going anywhere at the end of the 15 years because of how much they have invested in the building. But that's not necessarily something we should depend upon, right? Because for most of those players, even though it sounds like a lot of money to us to invest $100, $150 a square foot in robotics and other things, for them it's a rounding error, and they have amortized it over the first 5 years of the lease. And then 15 years later, when the lease does come up, they probably think they have a lot more flexibility than we would like for them to have. So as you invest in these assets, which I believe you do for a long hold, you don't do it as a trading strategy, it's a hold strategy. Are you experiencing any anxiety about what happens at the end of the 15-year lease? Are you making accommodations in terms of how you treat the assets and their amortization on your balance sheet, so that if the tenant does leave at the end of 15 years, you're not caught by surprise?
Yeah, it's a good question. We've had a lot of discussion, a lot of analysis on this for quite a while now, frankly. And look, I think we're coming to the view that that's the future. So right now, you look at these things and you go, oh, they're anomalies, who would want them? But I think, as we've seen e-commerce get bigger and bigger, and the need for distribution facilities to support it grow, and now, like I said, maybe multi-story getting much more common in North America, and also too NIMBYism in markets where people just don't want the stuff built. We're coming to the view that this is more the future than the past. So look, it takes conviction, and we've done a lot of work, and we could be wrong, but we certainly got much more comfortable, I'd say, in the last 18 to 24 months than we were back then.
Yeah. Dennis, what are some of the tough questions your board is asking you these days? Things that you wish you had more conviction around what the answer really is?
And, we've got a great board. They really help. I mean, these guys, the people, have been doing this for a long time. Their initial focus was correctly on the people. So they really wanted to know about our staff, how people were doing, morale, how it was going working from home. 1,200 people is a lot of people to have dispersed across the world, frankly. And that was, we spent a lot of time working on that and trying to sort out how we would react to this pandemic, which, as I said, many of my Canadian colleagues had experience with, I didn't. And then after that, it was the portfolio, and the obvious ones, retail in particular. we're fortunate only about 7% of our portfolios are retail, so it's a problem. It's, you know, it's like cuts and bruises, but there's no major, nothing that, you know, is going to really cause a huge problem. So we focused on that. We focused on our mortgage portfolio too. You know, this is kind of when, you know, you kind of find out where the issues and problems are. So we've been through an extensive review of that portfolio. And that was, those are the major things. There was probably one other one too. We have a student house. We're big in student housing in both the US and Australia and New Zealand. I got a little bit of help in New Zealand, and that we had entered into long-term leases with the university, so it was kind of a non-factor. And in the US, I must admit, I've been shocked myself at, you know, the rents that we're collecting are, you know, in the high 90s, which just is really surprising to me. And we're, in terms of pre-leasing for next fall, we're kind of on schedule to what we have done in previous years. Of course, if the universities don't open, then those reservations will fall away. So those have been our problem areas, and that's been what the board's focused on. And they're asking the right questions. So, you know, we scramble, get the work done, and you know, it's been good. So, I mean, you know, a lot of hard work though to get the answers in.
Good. Well, it sounds like you got a smart board asking you the right questions, and you're making you think. That's what you want as a CEO, right?
Yeah, that's exactly right.
Our
Take all the help I can get.
Well, it's good. I'd love for you to be helping me. So when you consider those questions and the experiences that you are going through now as a business, both external and internal, what changes are you already anticipating you're going to be making in your business, both how you operate, what you invest in, and how do you execute that investment program?
Okay, well, maybe let's start in how we operate. The biggest changes will be in retail. Not sure we need the deep spaces anymore, so how do you deal with that? Need to attract the online retailers, and need to spend more time building relationships with them. You know, we all have a lot of experience now with the department stores, but, you know, be dealing with the space they'll be taking, and then just shrinking things down. So that's how we'll be changing those operations. And then we'll be looking for opportunities where we can replicate what we've already been doing up here in Canada, outside of Canada. Industrial, I think it's kind of just more of the same with some of the issues we talked about in terms of densification. Multifamily, there's probably more software. We've put in some software where we're communicating directly with our tenants. They, you know, type in what they want. Everything's being done virtual. So I think the digitization of the properties is going to be huge. We're now, you know, working on programs. We're putting sensors all over our building, detecting not only operations of performance, but flows of people. You know, being able to deal with all that information and sort it into something that can be understood and decisions can be made from it is really critical. So I think that, and that'll be certainly probably first in office, but we're absolutely going to see it in the malls too. You know, and then in terms of what we're investing in, I think, you know, we'll go slow in retail and office, but look for opportunities. We'll go fast in industrial and data centers, and in multifamily, we'll go fast where we think regulations will be lighter. And then I think early stages too, will probably not be going as much into the equity, more structured things like mezzanine or preferred, stuff like that with a little bit of protection. And then as we get a clearer view as to when things will kind of resume, then we'll take stronger positions in the equity side. And one other thing too, I think there'll be some opportunities in operating companies, which, you know, we very much like to invest in the sectors we like.
I'm glad you brought it up, because I was going to go to that next. I know you've been buying interest in operating companies. It'll be great to hear a bit more, like, what is the motivation? What has been the reason? How did you make the decision to get in that business? How is it going so far? And how do you view that? Is that a driver for just a vehicle so you can put more money out in that sector, or are there other reasons why you're investing in operating companies?
Well, remember, we're one of the biggest real estate operating companies in Canada, so we do this. We've got 1,100 people here, you know, and from property management through development. So for us, it doesn't feel like it's something different. In fact, when we do our due diligence, we send our finance teams and our property accounting teams down, you know, and just say, hey, how do they compare to how we do things? And sometimes you learn, and sometimes we realize that we're actually doing okay. No, we like being in the business. We like being in the business primarily first for knowledge. We like being closer to the action. We like being involved in all the decisions. The onus it puts on us, we got to be fast. So, you know, we got to move as quickly as they do. And we do that in our business up here in Canada. So we think we can do it down there, and we have. So we've proven to some of our partners that, you know, hey, we're just as nimble as you guys. So you have to do that. So being close to the action, I think, makes us we have better decisions. You know, when times come like right now, it's easier to have higher convictions if you've kind of been there and watching things and be involved in things. When time comes to go ahead and make difficult decisions, I think it's easier that you really understand all the nuances, especially in distress situations. And then, you know, the way we view it too is that it generates product. I mean, we don't buy stuff off the street. We build stuff, make stuff. We pick out what we want to do. We go find out who we want to do it with, and that's what we do. So it manufactures our investments for us. And I guess our view too is that, you know, those, when we find good partners, when we can build a good equity relationship like that, we'll just stick with that. We'll never sell it. And it'll continue to, as long as we nurture it well and nurture the relationship well, it'll continue to be a great source of attractive product for us.
Is your view that they should be completely captive, meaning that they should only deploy capital on behalf of QuadReal, or are they welcome to, encouraged to go raise capital from other sources?
No, I think they can do both. Yeah, I think we're, you know, in fact, it almost, you know, like when I was at AXA, we were forced to do that. Best practices, we were funded by the insurance company, but over 50% of our capital was from third parties. When I was there, I also oversaw the fundraising part of the business, and we had 230 clients. And, you know, when you've got to service 230 clients around the world, plus your parent company who's giving you a big chunk of cash, it really ups your game, right? You know, you kind of get hit from what everybody around the world thinks is best practices. So no, I think doing both is good discipline.
For you, I agree. Last question on buying companies. What are the top three things that you look for that you think make a great operating company you'd want to be a part of?
Well, the first one's the people. It's always about the people. You know, I guess one of the reasons you buy an operating company is these are people that you can't hire, right? They don't want to work for anybody. They want to work for themselves. They're usually very, very good at something, either a market or a property type. They have a skill that is really unique that allows them to be very successful. So this is a way for us to get access to talent and people we can't hire. So that's always number one. Number two is that they're doing something we like. You know, so frankly, if they're not focused on what we want to focus on, then it just doesn't really matter. And then three is that they're typically in markets that support what they're doing. So you can be the best at what you're doing, but if you're in a market that just has no prospects, it just doesn't matter. So those are the three things.
Which parts of America you think are going to outperform other parts of America?
Yeah, you know, that's a good question. And, you know, the answer of the American answer, and I can say this because I'm American, is always growth, growth, growth. But I did work for 10 years in Europe, and I learned that it's not just growth, it's also, too, the spread between your cost of capital and the growth. And growth can be low, but if you have a good spread, you can do just fine. And when you have markets that are growing, 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 you also have to look at supply, supply, supply. So, I don't know. I think, to be honest with you, I'm rethinking that a bit right now. And yes, there's the, you know, just the Austins and Asheville's and all that kind of stuff people like. But, you know, the Midwest has kind of been overlooked for a long time. And maybe there's some opportunities there. So I think with this pandemic, we're kind of thrown out all of our old views and kind of just re-looking at everything again and saying, well, where is there really value? And you don't have to have super growth if you have no new supply. You have steady growth in rents, and you've got a low cost of capital.
Does blue red play a factor in your analysis?
Well, blue's the problem with rent control, right? So that's a problem. And red is typically more freer markets, open markets. So it's not. There's a lot of blue states that are thoughtful about business. So not necessarily, but it's a leading indicator.
At least it's a factor, right?
It's a leading indicator. It needs to be explored further.
Good. Well, this has been a great conversation. Maybe a quasi-humorous question. Looking out maybe 3-6 months, what do you think will have surprised us? What will catch people by surprise?
I don't know, maybe all these bullish people in the stock market will realize that there's more fundamental problems than they think.
Is that what you think? You think that we're going to have a second a stock market crash coming up?
I don't think we'll have a crash. They've thrown the central banks have thrown too much money at it, and then by the way, they've all done a great job. I mean, it's been unbelievable. They really learned in the GFC, and I mean, they were so quick, and it made such a huge difference too.
Good.
So no, I don't think it'll be a leg down, but I think it will be maybe a very long swoosh. I don't know if these V's. I don't believe in a V or even a U. I think it's maybe a very long swoosh.
Right.
But so that, and you walk away from all these things too. If you remember September 11th, what it did for security at airports, it just changed the world. We never would have imagined that. So I don't know. So it'll probably be something along the lines of health. We've decided, the term ESG, we've just started calling it ESGH now. And there are going to be things that we didn't think about with health that we're going to have to take into consideration. I mean, simple things like materials on handrails and things like that. So yeah, it's going to change our world, and we're going to be thinking about health much more. I know many of us North Americans were always amazed at people from Asia that would be wearing masks around all the time. Couldn't quite figure that out. Now we get it. So I think we'll be surprised at how much more health becomes an everyday factor in our lives.
Dennis, this has been a great conversation. I really appreciate your time. You're sharing your wisdom. QuadReal is lucky to have you at the helm. I'm sure your team feels the same way, and I know that I'm privileged to be your friend and your colleague. So thank you for sharing your views, and I look forward to seeing you soon. Stay healthy and stay safe.
Hey, thanks, Scotty. It was a pleasure. It was a lot of fun, as it always is. So look forward to seeing you again soon.
You bet. See you soon.
Take care.